I'm going to talk about starting a high-tech venture, a Silicon Valley perspective. Let's all get going a little bit here and have a show of hands. What do you think makes a startup successful? Is it ideas? Show of hands. Okay, ideas. Some people think ideas. Team, is the team? Oh, a lot of people think the team. Business model. Okay, yeah, business model, not so important. Funding, very unimportant. Timing, a lot of people think timing. Okay, so I guess the short answer is all of the above, right? You need all of these, and so you're all right. Now the bad news is, of course, even if one of these doesn't work out, it can lead to failure, and that's why it's so much harder to have a successful company than a company that goes under. In fact, everybody here knows that most startups ultimately do not succeed. So goals of my talk, I want to explain to you the mental model, implicit mental model of Silicon Valley startups. And maybe later on when we talk over dinner, you can tell me whether this is the same for Munich, or maybe in the Q&A. So I would be very interested to get your perspective on that and see whether there are differences here, or whether maybe it's the same. My personal experience, mostly about startups in the US and particularly in Silicon Valley. I've been a founder twice. I've been an angel investor for about 20 years now. I've looked at literally hundreds of startup companies and invested probably in about 20 of them. So that's what my background and experience is. I want to share some personal investment rules. What are great founders and why do most startups fail? And then, as kind of a practical take-home thing, show how to avoid some of the most common, or actually to avoid the most common failure mode. It's a simple framework I brought for you that greatly increases your startup's success. So let's jump right in. These are typical phases of a Silicon Valley startup. 3 phases. There always need to be 3, of course. People have different names for these. We're just going to call them the early stage, the mid stage, the late stage, or some people call it validation, revenue, and scaling. Let's see, one of these. Okay, oh, here we go. So early stage, typically 6 to 18 months, focuses on product development, product market fit. Small team, 3 to 10 people at most. That team would be led by the founders. And the key milestone of that would be a product launch or initial paying customers. In the mid stage, the revenue stage, the focus would be on the sales funnel and customer engagement and partnerships. The team grows 10 to 100 people, led by the founders and maybe a management team. Key milestone would be a sustainable multi-million-dollar revenue, and ultimately you want to become cash flow positive during that stage. And then, stage 3, late stage, is world domination. As long as it takes after these first 2 stages. Revenue, market share, building the brand, large teams, 100,000 or thousands of people, and you would probably not have the founders lead these teams. This would be an experienced executive team. Often management comes in, the founders go out, maybe become board members, maybe they go off and start another company. It's a different skill set, and key milestones for that, the goal would be really a dominant market position. So, startup, it's important to realize, it's really a temporary organization, right? It's not a permanent organization. You're building a temporary organization to build something bigger and greater. So, the whole thing, at least in the Silicon Valley mindset, is governed by the cash curve. Who has seen the cash curve before? Hopefully everybody, right? But maybe not everybody. Okay, so let me quickly explain. This is aggregate dollars. If you go negative, you spend more than comes in. and as you go positive, then you have more revenue than you have spent. But this is in the aggregate from the beginning of your company. So of course, early on you start spending money, but hopefully not a lot. So this is sustained by seed funding. Then you increase the burn rate, right? This slope here is what people call the burn rate, usually as a monthly spend. You're dipping more into the negative. Of course, you need funding for that, Series A, B, C. At some point, you reach the bottom here, right, of this cash curve. This is a very important point. What is that point? What do people refer to this as what? Some people call it break even, but it's actually not break even. Break even is this point here. This is when the company becomes cash flow positive, right? So more money comes in than you're spending. And if you just track out this cash curve, you see what the minimum total investment needed is to build your business. Okay? Good. This is, we're going to return to this. This is when things go well. Now, I already alluded to the financing rounds. There's a very typical model for Silicon Valley startups, and it's probably very similar here as well. So seed funding, usually a few $100,000, comes from FFF, founders, friends, and family. They put up the money, but maybe also angel investors, people like myself, or in the last 10 years, increasingly accelerators. Typically structures as a convertible debt, so it's not an equity investment. They loan you money with the expectation that it's going to convert into equity if there is a larger funding round. That would be usually Series A, few $1 million, depending on what the cash needs are. Typically, one or more venture capital firms would invest in exchange for equity. Typical equity percentage that you give up in Series A is 30%. The investors take board seats, and they receive preferred stock with the liquidation preference over the common stock, which is what the founders own. Series A, B, C basically just repeats that procedure, gets more money in as needed. Again, venture capital firms, maybe corporate investors in the later rounds. Usually corporate investors will not be found in earlier rounds because it tends to restrict the type of business deals that startup companies can enter. And again, cash in exchange for equity percentage and board seats, and newer series of stocks which have liquidation preferences over the previous the series of stocks, and of course over the common as well. Now, venture capitalists, why are they doing this? They're looking for return of investment, and the return of investment is shockingly high for a VC. If you talk to them, say, hey, invest in my company, they say, well, show us how you're going to generate a return of investment of 50%. Well, you say 50%, I think we can do this. Well, it's actually 50% every year, right? So year over year, 50% return of investment. Why do they have such high return of investments expectation? Because most of their investments will fail. 90% of Series A tech startups ultimately fail. So the few that actually do make it will have to pay for all the other investments. VCs usually look for a possibility of a liquidation event, an exit after 6 to 8 years. That's in the form of an initial public offering or an acquisition of the company. Acquisitions are a lot more frequent than initial public offerings. And I've already talked about the need to spread the risk over many investments. So at the seed stage, where people like myself invest as angel investors, you often don't have a business model. And you have some general ideas, you have a team of founders, but there is no validation of what the business might be, and it often changes. So how do you recognize that this is a good company to invest in? Well, it's really all about great founders. And people like myself look for passionate and fully committed teams that are motivated by the impact of what they want to do. They should have a strong vision, but should be willing to learn and able to adapt. Right? So there's a little bit of a tension there. You have a strong vision, and then you just move forward and say, oh, the others don't get it, but my vision is so strong. But so the balance needs to be there. The emphasis, I already said team here, but I can't emphasize this long. Investing into solo founders is usually not a good idea. Companies that are founded by not a team, but a single founder are a lot more likely to fail. So teams are important. In the team, you want to have at least one technical co-founder. High growth ventures, which is what we're talking about here, almost always are driven by technology. And if you don't have a technical co-founder, it's very unlikely that you're ultimately gonna succeed. The business idea that the team sets out with should address a sizable current or future market. What is sizable? $1 billion or more. Okay, so that's if you have a market of a few tens of millions or even hundreds of millions, that's not a sizable market. It should be $1 billion market. Why? Because the company is only going to capture a small share of the market. You're not going to capture the whole market. Right? So in order to build a business in that market, the market needs to be large, or at least not small. And last but not least, the quality of the founding team is probably the most important parameter. Is that a strong team? Why? Because I'm going to talk about pivots later on, but more likely than not, the team is going to pivot. The business model is not going to work out. They're going to have to do something different from what they set out to do. So that really depends on the quality of the founding team rather than the actual idea that they start out with. So why do most startups fail and some succeed? So these are some findings from the Startup Genome Project. It's a project where Stanford plays a big role in. My colleague Chuck Easley, they have tracked 3,500 startups and looked at their trajectories and looked at all the factors that correlate with success or failure. So the least successful are the solo founders, and unbalanced teams are also a good predictor of failure. So particularly if you have no technical co-founder. Startups that have helpful mentors, track metrics and learn from startups through thought leaders, raise 7 times more money and have 3.5 times better user growth. So the fact, if you're starting a company and you're here, that's probably already a good sign, right? So, but you wanna particularly have mentors, advisors who have some experience with starting companies and that share their experience with you. Very, very important for the success of the company. Now, startups, that's another finding from the Genome Report, very, very highly significant. Startups need 2 to 3x longer to validate their market than the founders expect. So this leads to something that's called premature scaling, which is the most common failure mode. 75% of the companies, 3 out of 4 startup companies, fail because of premature scaling. Premature scaling means you start spending money too fast before you have validated your business model. And the money is spent on staff, on marketing, advertising, et cetera, et cetera. There's the temptation once you have raised money to maybe buy customers, but that's not sustainable. It's so premature scaling, 75% of the companies go under in this mode. And but then startups might have to pivot, and startups that pivot once or twice are half as likely to scale prematurely than startups that pivot more than 2 times or not at all. So if you look at the distribution of successful companies, pivoting once or twice is common. Probably your funders will not go along if you pivot more than 2 times, but not pivoting at all is often also a sign of stubbornness and not being adaptable and not learning from your attempts to validate your business model. So, returning to the cash curve, early stage, mid stage, late stage, the funding, the burn rate increases. Here, you raise more money through your Series A, say, So what happened? Why does this curve not just go down here? Well, it's because of revenue, right? So you get revenue that comes in. Ultimately, it balances your expenses. If you don't get the revenue, basically you just end up in the ditch, right? And it's very hard. Once you're down here, it's very hard to recover from it. So that's the premature scaling. And we really need a principled framework for this transition between the early stage and the mid stage that helps you decide on whether it's actually warranted to start spending more money on marketing, on engineering staff, et cetera, right? So increase the burn rate. And then, as you continue to ramp up your expenses, you wanna always check whether you're doing the right thing. So the last thing I wanted to give you, as I said before, is basically a simple framework that you can use to check whether it's time to scale or whether it would be premature. And that framework is basically just a straightforward application of design thinking. We are big in design thinking at Stanford. It's a very useful framework for many applications. You can think of design thinking basically as a way of managing complexity and minimizing failure risk in product development. And there are these three circles that need to intersect. One is desirability. Are we doing something that people want? Feasibility is the second one. What is technically feasible? What is organizationally feasible? And the third one is viability. What can be financially viable? And you need to sit at the intersection of these three things. Otherwise, your business is not going to be successful. So here are 6 questions that I derived from these 3 circles. And you can see the colors and desirable, feasibility, viability. That's actually a framework that we use working with startup companies in the seed stage to see whether they are ready to enter the next phase and start increasing more money. So what are these 6 questions? Regarding desirability, are we confident that our solution fills a genuine customer need? Has the product market fit been validated sufficiently? And the second question is our solution intuitive? Is it easy to explain to potential customers? Very important, right? It's if you have something that's great, but you can't explain it to customers, they might never realize what a great thing that you have. Feasibility, that's about the technology mostly, right? And the team. So is the technology well understood? Is it available to us and ready for deployment? The technology, you might master it, but it might not be available to you because somebody else has patented it and is not willing to license it to you, right? So do we have the right team to execute our plan? So that often means, do you actually have the people who master that technology and also the complementary skills of on the business side. And last but not least, the viability. Will our solution generate enough revenue for a sizable and sustainable business? Is our plan to get there both realistic and robust? So typically, I ask people to work out 3 plans, kind of a realistic, optimistic, and pessimistic plan, and hopefully that brings out some of the robustness of the assumptions that go into the plan. And last but not least, are we ahead of current and potential competitors? Do we have, what's called an unfair advantage with competitive barriers? So that could be intellectual property rights, could be a unique business model, could be network effects. So 6 questions. Each one of these 6 questions is essential. Venture capitalists, if they are good investors, are gonna ask you about all these aspects of your business, and how should you then use this readiness checklist? Well, you're basically gonna review and answer each of these questions. Ideally, you do that not just with your own team, but you do it with advisors and mentors, people that keep you honest. Otherwise, there's a danger. As they say in Silicon Valley, you drink your own bathwater, and you just get high on your own ideas and lose the objectivity. So it's good to have outsiders to really challenge you on your assumptions. For each unqualified yes, you get 1 point. For a no, you get 0 points. Maybe there are half points occasionally when things are in reach, but you're not there yet. 5 points or more, you're ready to scale. That's a pretty high bar, right? 6 questions, you need 5 yeses. Why don't you need 6 yeses? If you have 5 yeses, it means you have 1 problem area. And you can scale the business and still work to solve that 1 problem area. You will not be able to solve 2 problem areas and scale the business. It's just too much, and it's going to overwhelm you. So 5 points, and if you don't get the 5 points, you should think of a plan to get there. If you cannot think of a plan to get to 5 points in the foreseeable future, that's the time when you need to pivot. You need to be honest and say, well, it doesn't look like we're ever going to get to the point where it's justified to deploy more resources. Let's come up with an alternative plan. We still have some money in the bank. We have the passion. Let's see what we can do with what we have done so far. And typically, I like to repeat this exercise with startup teams that I work with every 2 to 3 months. So even before they know it's time for scale, they already know they're not ready to scale, but it's a good exercise to do, to be honest and say, oh yeah, these are key areas that we need to address to get ready to scale. So with that, hopefully something practical, and questions, please.
Yes, can you show the 6 questions again?
Yes. I think we're going to have the video, but feel free to just take out your smartphone, take a picture of these, and you can start tonight maybe to review these with your team. Other questions or yes?
If I were to have a startup, how do I find a good mentor?
And he said how he can find a good mentor at a startup. Just to repeat it for the audience.
So who are the best mentors? What would be your ideal mentor? If you probably somebody who has started a company, right? Somebody you trust, and somebody who knows your space. Okay, so that narrows things down to probably only a few people. You're probably going to know who these people are, but chances are they're not going to know you. So you're going to go to them and say, I'm starting this company, and this is, we are very passionate about it, and can you come and look at what we're doing, give us some feedback, and maybe even be an advisor, and you're going to be surprised. Because people, particularly if they have started companies, if they know this space, they're going to be very excited about what you're doing, and you're going to be able, more likely than not, able to engage them. You will typically give them a little bit of equity incentive in form of stock options. Right? This is kind of, it's kind of customary to do that. These stock options are going to be worth exactly 0 most of the time, right? Because but because the company is not going to become a big success. But if the company does become a big success, then there's some nice windfall for the advisor. They're not going to do it because of that, but because they love you and your idea and your team. That's at least the Silicon Valley answer. I hope that's the way it works in Munich too. Yeah, exactly, right?
Probably.
Yeah. Mm-hmm.
In terms of team composition, do
Yeah.
you expect teams of founders, for example, if you have 3 founders, do you expect them to have different backgrounds?
Ideally, yeah, because if they all have the same background, they're probably missing something. Nobody in this complex world, you're probably not all going to be Renaissance people who are equally strong on the technology side, marketing. I've learned as an engineer. We're starting companies and say, oh, wow, we got great technology, let's just start a company, the world will need this. And guess what? No, they don't. I had to learn that, for instance, people with marketing background, really important to get them on board early on and discuss with them and see, what the company actually is, what the business model is. And so, you want to have people with complementary perspectives. I'm a big believer, by the way, also to have women in the founding team. So, one of the things that I do now is work with an incubator that only supports women-founded and women-led companies. Unfortunately, the percentage of women is low, particularly in the Silicon Valley. So chances are that your typical founding team is all going to be male. But, yeah.
You just touched a very interesting point, which is the lack of participation of women in the startup. Actually, not the lack of participation, but the lack of support. So what's your opinion on the gender bias there is when supporting startups led by females? And another question to that, what would you say in your experience are important traits that women have to have in order to lead a startup?
First of all, that gender bias clearly is there, and it's probably more pronounced in almost any other field that I know than if you just look at the statistics. I mean, there's in the startup world, Silicon Valley certainly. I mean, there's less than 10% women founders. It's partly related to the fact that all the men make the funding decisions and serve as mentors, and it's very, very fast paced. So they tend to make these snap decisions, and when you make these snap decisions, there's psychological research that shows, then you're actually looking for somebody who's just like you. And so that's unfortunately a self-permeating thing. Now, the good news is that there are quite a number of people in the community now that recognize that and try to change it. So there's some funds now in the US that have more emphasis on female founders. The women who do start companies because of that, unfortunately, need to be quite resilient. And it helps that resilience to have no other women founders and be in a network there, compare notes. I mean, that's why we did the incubator just for women-led companies, because they can talk to other women who start companies and share some of the experiences. So that actually helps them. Also changes the culture a little bit. And but it's going to be quite a journey to really get to parity there. And we're missing all these great companies that women are much more likely to start than men. So there's actually a good business rationale also to invest in women-led companies, because these are often not companies that men would start. So hopefully we'll continue to make progress. And
you mentioned frequently that teams are the most important factor. One of the most important factors in founding.
Yeah. Well, all 5 of them, right? It's
So normally the idea that leads to the venture comes from one person. It's very rare that a team conjointly finds an idea. So have you experienced ventures failing because the motivation to pursue an idea was so large in the founding and others losing faith more quickly because the idea wasn't theirs?
I mean, that can happen, right? It's particularly if there's one founder who's maybe very much attached to a particular idea, and the other founders are less so, and they realize, we need to pivot or modify this. And I mean, a lot of founders come out of the academic realm. Let's say somebody who has studied 5 years before they get a PhD. They're very much they want to apply their technology area, and then if they look at what the customer needs are, maybe then learn that the customer needs are a little different, and you can provide a good solution, but you wouldn't need that technology. That this founder actually spent 5 years developing in the PhD. That can often be a difficult moment, right? But if the team is good, they're gonna master it. But quite frankly, if there are frictions within the team and people don't work together well, I mean that's maybe the least tractable of problems. Yep.
If you had to decide, would you rather invest in a startup who has an incredible idea or the most incredible idea, or rather in a startup who has has a simple idea but knows how to execute it?
I'd say.
Could I just repeat the question
Yeah.
for the audience? So if you would invest in a simple idea rather than a great idea which is not easy to execute.
So I think your combination was simple idea, but a team with great execution versus incredible idea, but maybe a team which is not so incredible, or is that maybe? Yeah, maybe not yet. So I'd say ideas are a dime a dozen. Definitely the team that can execute. Simple is good, right? When it comes to ideas, these ideas are going to change. They're important to get started, but they're gonna hopefully get modified as the team tries to validate the idea and starts working with prospective customers and learn from them. Because at the end of the day, you're only going to build a business if you solve a problem for somebody. Right? You need to ask, who's my customer? What's the problem we solve for them, and why are they willing to pay money for it? I mean, it's that simple. But often this can be a very simple idea, right? There's no magic to having an unbelievably ambitious idea. So,
okay.
Yeah.
I think
Are we?
Last question.
Another
Yeah.
question.
Yeah.
In your experience, what are the differences between the startups in an ecosystem like at the Silicon Valley or here in Germany? Are there cultural or based on the technologies that?
I think so, but I don't really know the answer to that question. I know the U.S. ecosystem really well. Particular Silicon Valley. Over the last years, I spent quite a bit of time in New York City and their ecosystem, and I learned some of the differences there. There are actually, quite remarkable differences. I suspect there are fairly big differences also in the German ecosystem, but I don't know it firsthand as you do, or many of you do. So hopefully we can tickle this out later on in a conversation and maybe compare some notes and from what I said, whether this kind of is mirrored here or whether there are big differences that you see. So my hope is learning from you a little bit on that.
Please
All right.
another round of applause.